Hello and welcome to Switzer Investing. I'm Peter Switzer, and on tonight's show, Jun Bei Liu answers my question about whether the market's bounce backs in recent times that we've been seeing, particularly for tech stocks and the overall market for that matter, when bond market yields start to drop. Is this a sneak preview of what should happen to stocks later in the year when the market headwinds of inflation, spiking interest rates and recession fears abate to be replaced by more positive tailwinds? And then Michael Gable of Fairmont Equities looks at the charts to see if a sustained market upturn is happening right now, and he looks at the charts for Megaport, Magellan, Aristocrat and more. And then Paul Rickard thinks healthcare stocks will improve the overall health of your portfolio, but which ones? That's the show ahead of a week when we get the latest inflation number out of the US on Wednesday, and then our latest unemployment figures come out, where both statistics could have a really big impact on what happens to interest rates first and then ultimately on stock markets. So let's kick off with Jun Bei Liu of Tribeca Alpha Plus Fund. Thanks for joining us, Jun Bei Liu.
Thank you for having me, Peter.
All right, so I want to take you back to Tuesday last week in America and Wednesday here. And the Americans got more worried about recession and therefore the bond market, its yields fell, and all of a sudden...
The world was going to end.
That's right.
That's right.
So,
yeah.
so good quality, cyclically inclined companies like BHP were sold off. And companies that have been despised for the last 6 months, tech stocks, were bought. Is that a sneak preview of what might happen when later this year they decide all those interest rate scenarios were excessive and hopefully Ukraine war might be over and China is supplying more and inflation is coming down? Is that a sneak preview of what probably will happen to a lot of those beaten up stocks?
Look, absolutely. I think we've been talking about this for a little while now.
And praying for it to happen.
That's right, praying for it to happen. And when it happens real fast. And but that's definitely a sneak preview. What's interesting is that the bond yield. You talk about the bond yield. So the bond yield jumped significantly just about a month ago when everyone said, "Oh, look, inflation and everything. So sell growth stocks, so interest rate going higher." And then just about last week, and suddenly bond yield fell significantly just on the basis of all of a sudden people worry about recessions and and then they realize that the commodity prices will be hurt by recession even though China may come back. So absolutely, we're already seeing the growth companies, especially the leaders, the proper growth company that has real businesses, they have jumped significantly in terms of share price, but that's still way below, if you look on the 12-month basis, still way below what they were 12 months ago really.
You've been in funds management for quite a long time. You're not an old person, but you've been in funds management a long time.
Almost 20 years.
Yeah. So do you think the volatility in the market and the reaction in the market is much more excessive than it was when you first started? And I'm kind of presuming computers and the more diverse stock market audience might be behind it. Well, is it a fair call?
Oh, absolutely. You're absolutely right. So it's certainly increasingly hearing more professional investors say, "I've never seen this before." It's simply the market become more passive. There's more computers, and then the active managers. There's less active managers. There's more retail investors. So all of that together just means things are happening very fast. So previously, when we go through the whole cycle, so when the inflation started picking up, when the interest rates started going up, and then before you get to the recession, generally take about between 18 months to 2 years. It took us 3 months.
That's right.
That's right. It took us 3 months to move from, oh God, inflation, things too hot, we need to bring it down, and then, oh God, we're going to have recession. So there's a lot of people actually sitting in the market saying, look, how can it be over when we haven't even started? We just come out of the pandemic. So, so that it has created a lot of volatility. But what this environment is actually really good for stock pickers, for investors to actually understand those businesses. Because market is just so broad brush looking through everything. Sell the whole sector, sell resources, sell growth, sell everything. Don't care what the company does. And now we're heading into reporting season. So actually there's a lot of great return generating opportunities heading into it because all the share price have fallen. And if you get the earnings right, some of those companies may not be experiencing those dire situation.
Yeah, it seems to me like a company like Xero is very different from a company like Nuix. But they kind of get treated the same way on the same day.
Down as much.
Yeah.
For a large, and Xero being such a large cap as well. Yeah. And it's fallen as much. You know, share price touched, I think, $75, $74 at one point, moving from $150 probably just a year ago.
Yeah.
You know, we think it's incredible amount of value sitting in this business. We do think in the next 12 months, a business like Xero will be bought just because they don't really require the buoyant economic activity for the business to grow. You know, they're just going to new markets, doing their day-to-day business, very, very defensive. And then the you know, like you said, the valuation tool, which is the bond yield, is stabilizing. If anything, it might be moving the other way as the you know, inflation start to tapering off, and then the interest rate expectations comes off.
Okay, so before I go to the banks, I want to talk to you about the banks in a moment, but are you saying then that probably in once it's realised that interest rates aren't going to create a terrible recession, and therefore interest rates also aren't going to rise aggressively, that there'll be a rotation back into quality tech stocks first, and then eventually those great ones of the future, and I name them like the Megaports and the Ordinates and all those ones, will probably get picked up after the quality ones, or you think they could go at the same time?
So, okay, that's a really good question. I think the first one to go is actually healthcare businesses, because healthcare is just defensive, and they've been sold off like CSL because of various reasons, or well, because of the COVID effect.
Well, Paul Rickard said the same thing.
Yeah, and
he thinks healthcare is going to be liked pretty soon.
I think so. So healthcare will be the one that will be very defensive, whether you have recession, not recession, and they will grow double digit, and regardless, and they're cheap enough, so it's good. So putting healthcare aside, the next one is actually the tech will do well, the big tech. Now, if the bond yield, so at the beginning of the bond yield stabilizing, so, you know, pretty much like now, you know, you will start seeing the one that's been sold off a lot to start moving quite quickly. The likes of Megaport, the likes of potentially Tyro, but likes of those names potentially move fast because they come off so much, and their valuation, because they don't make money today, you know, not cash flow break even yet. Megaport will almost, and their valuation is so sensitive to the future interest rate expectations. So these ones will actually move by a lot compared to the larger tech.
Right.
But only thing is, you know, just because we still got a bit of uncertainty, you know, there might be a recession in the US, mild, right? In the US next year or the year after, and in Europe, Australia will probably won't get there. But just still there's uncertainties out there. We still got the war going on. So those names, they may jump quite quickly, but then they will be volatile. So the defensive way is you play healthcare, play large cap defensive tech, and then you move into those ones in a small way.
Yeah, and if you miss the first 10 or 15%,
it's okay, because you've got to make so much more.
Yeah, there's dropped so much.
Exactly, you're not talking about 20, 30%, you're talking about doubling, tripling your money there.
We got a question on Boom Zoom Zoom on Thursday about the banks. And in America, when interest rates rise, there's an instant belief that, banks will make money. Now, here in Australia, the view is that, well, interest rates don't necessarily instantly make money for a variety of reasons. But I've always thought that it works this way, and correct me if I'm wrong. During the interest rate rising cycle, the banks will make money. It's when it starts hurting the economy, that's when the problem will come for banks. So it seems to me our banks have probably got at least 12 months of having improved profits because they're charging higher interest rates. The defaults are really low, bankruptcies are really low. So is that a fair analysis?
Oh, absolutely. Yeah. So when I said, people say, how can it be over before you even started? This is exactly referring to the banks. They're earning, still recovering from those low interest rates. And now finally when it's rising, it's extremely sensitive. And look, you know, the market's moving on so fast, you know, looking forward to potential recession. I think it's pretty good here. You know, and our inflation is not like half of what they experience in the US. Our interest rate is not going to get even anywhere near what the US is going to do. Our employment market is good, and our corporate is still recovering from the COVID lockdown, which was just finished early this year. So, you know, our banks will have pretty good environment for the time being. I think it's way too early for investors to be really selling them off and worry about, the recession.
What bank do you like then amongst them? I know we all like CBA, but CBA is always priced to perfection or priced too high. But which one of the other three do you like?
Look, I do like NAB is a good business. But it's outperformed and everything. A little bit more expensive, but CBA is the most expensive. You do want to stick with quality. However, I do have my one foot in the cheaper bank like ANZ. Really, just it's valuation wise a bit cheaper, give you a bit of sort of little bit more extra. But net, I think the whole sectors will be okay. And then the dividend yield will be enormous from this sector. I think this reporting season you see the big miners paying out a huge amount of dividend as well as buyback, and then the banks will pay a lot of dividend now. And next 12 months is looking very strong.
Are the miners a buy at this point?
I would think so. I honestly, I think heading into the results, people worry about the short term. Look, I think the miner has outperformed, so market is selling them and buying something else. But I do think heading into reporting season, they're going to pay enormous amount of dividend, in the double digits. Particularly for the large diversified, you certainly will be buying some for those announcements of the dividend. They will outperform.
So do you think some sneaky fund managers, not like you of course, but some sneaky ones will buy the miners, get the dividend and then dump it and go chasing tech or something like that?
That's what they do every year.
Okay.
You buy it and then you sell it before the dividend go ex-dividend. Because there's just so much demand for those dividend income funds. What are you going to
you get the price benefit of everyone chasing the dividend.
That's right, and then you don't wait till it goes
ex-dividend.
You don't wait till dividend
Guys,
comes
you
out.
guys are sneaky. I never thought you'd
Any
like
extra
that.
return we can get.
Okay, a question I got from Boom Zoom Zoom on Thursday was an interesting one for me. Babcorp. Been a great company. I don't know if you've ever been interested in Babcorp, but I emceed the Automotive Dealers Association conference, which I was telling you before we interviewed. And the one thing I thought about was, we know used cars have really been bought like never before. That's probably going to be a good thing for Babcorp, that actually provides spare parts to the mechanics and the panel beaters that fix up used cars. What do you think?
Oh, absolutely. I think that whole car space, the used car space, just experiencing so much demand and the backlog as well. So when the COVID hit, and then suddenly when there's a bit of reopening because the borders are closed, so people can only drive. So demand for driving, anything to do with driving, has been incredible. Then we had the supply shortage, so we couldn't get the chip, so we couldn't get the new car. And then suddenly even car dealership couldn't supply the demand because there's just no car coming in. So all of these guys have been actually experiencing difficulty during the environment. It's meant to be amazing for them. So the backlog is huge. And I think for this company, the driving holiday is still here to stay. They will still do very well. Only thing is, I think when the border do reopen, there will be a bit of quietness on the roads because people fly. Everyone will book that holiday on to fly. But regardless, people will still drive because everyone can get a slot internationally.
And I also think there's a lot of scaredy cats who won't fly overseas until there's no more headlines about COVID, and so they will stay home. All right, the next issue, what are we going to do about buy now, pay later? Is that party over, or will it ride again and only certain companies will?
I think with that sector, it's really the M&A is going to be the next wave that's going to drive that sector.
Because there's too many joining.
Too many. They need
the big
to
ones
get
are
together.
joining in.
Exactly. The big one joined together. So Afterpay and Square, so that's together now. And then so you have to see that whole consolidation happening. So Zip and Sezzle have merged. And then a whole lot of other ones, they're trying to do the same thing. They just have to, the M&A has to take place. Because if you don't do it fast, or if you don't align with another one, you might become irrelevant. Just because money's more expensive to come by, and then the churn is getting a little bit harder just because people are doing services rather than just the goods sales, because that was a big market for those buy now pay later. So in this environment, they need to merge fast, and the landscape is changing very, very rapidly. And I think in the next 12 months, I think a lot of them won't be listed. They have to merge with someone.
But why wouldn't? I heard Morgan Stanley's Gorman, who is an Aussie, of course, the CEO. He was talking about how they're going to get into buy now, pay later. Why wouldn't banks buy a company like Zip that's so cheap now compared to where it was? Like an ANZ. ANZ, of course, is in conventional banking now. And buy now, pay later is like a new arm of conventional banking. That they've got our wealth management. I would have thought some of the banks would, like, we know CBA's got Klarna.
Klarna, yeah.
Yeah, why wouldn't one of the other big four banks look at something like Zip or another one?
Oh, absolutely,
Yeah.
or Tyro, or any of those. I think the banks should. The only thing is that because banks are normally a little bit, trying to be conservative, right? Don't want to take the risk and potentially for reputation and things. So right now, because the regulation potentially will be changing and all of that front, so maybe they're just holding back on that. But ultimately, the sector has to be bought.
Yeah,
they
you're
work a lot
you're
better.
buying a young demographic.
Exactly.
If the older people aren't doing it, the young people aren't going to run away from it, even if the regulations saying, be nice to the young people. Young people don't like credit cards, and they like this buy now, pay later space.
Absolutely, and I think all of that has so much crossover. Say merge with Tyro, it'd be like Square merging with Afterpay.
Yeah.
So Tyro can merge with something else, and then sit within a bigger platform, and then you can roll the whole service across everything.
Yeah.
I actually think it makes a lot of sense. Potentially it's in the works.
Yeah, let's see if that happens. All right, so I've asked you about all the stuff I want you to ask about. Is there any company that has come on your radar screen that you really like right now? This will be the final pasteurisation I'll give you. But is there a company you said, yep, I really like it, looks really good for the future?
Yeah, look, I think I really like this. This company recently got into my portfolio, Jones Lang Group.
Yeah.
Yeah, so JLG.
So real estate group.
No, so not
Jones Lang.
My pronunciation, JLG is the code.
Yeah.
Not Jones Lang. My Chinese pronunciation. JLG is the code.
Yes.
And so what they do is that it's a tiny little company. They provide construction, not just construction, fixing up bits and pieces for insurance companies.
Okay.
Yeah, and
so that's like a back office
No,
thing?
not back office. So if insurance, so for it's not natural disaster. For example, your house is leaking, and you call up your insurance company, going, it's leaking, and then normally most of the market individual will go out and get their fixed, and the insurance company will pay you, right? So, but what they do is that they have a contract with the insurance company, and then the insurance company just go, you know what, I'll get these guys to fix it. So they guarantee quality, and then they overall cheaper because they always have a long company been around for 60 years.
Yeah. So they're effectively a building repair and maintenance.
Repair and maintenance, very, very defensive sort of earning stream. They have access to all the all the insurers, and they're the largest in Australia. Very fragmented because normally it's mum and dads going fixing up those things. And they just recently got into strata as well for the large buildings and things.
Interesting.
And then they do all the natural disasters as well. And then they just recently
plenty of those lately.
Yeah.
Their roofing work would be going through the roof.
What that does is that no analyst forecasts those natural disasters, and once you have the natural disaster it takes a couple of years to build them. So it's constantly an upgrade cycle. Last year upgraded 12 times. This year's already done it 3-4 times because analysts don't forecast those earnings, and once they're there for the next couple of years. And it's just been incredibly consistent in terms of earnings. Share price cratered because it was expensive, but now it looks pretty good value.
Okay, JLG.
JLG.
We'll look up the correct pronunciation, and we'll put it on screen. But Jun Bei Liu, thanks for coming on the program.
Thank you very much.
Well, joining me now is Mike Gable of Fairmont Equities, and we've got Mike looking at a number of charts to see if there are some positive signs for the overall market and also for some individual stocks. Mike, great to see you.
Thanks, Peter.
Let's start off with the big picture of the indexes. Do you think we are seeing a bit of a sneak preview of what might eventually happen when inflation starts to dissipate, maybe the Ukraine war eventually ends, and interest rate rises have come to a halt for a while? Do you think the market will then turn around and say it's time to buy some of these stocks and the market will start rising?
Yes, I think to get a sustainable rally again in the market, it will hinge on what's happening with interest rates and of course what's happening with inflation. So as soon as it looks like either inflation has peaked, but I think most importantly, as soon as it looks as though we're not going to get more rate rises and central banks will pause on the rate rises, that's when the market will rally. So in some ways we've got a bit of a sneak preview of that, where a fall in commodity prices over the last few months and a fall in the long-term bond yields, in the last few weeks, has given the market a little bit of optimism that we're not going to get all these rate rises, and therefore it's starting to move higher.
Yeah.
But to be honest, I think that it's still early days. I think that we will have rate rises this month, next month, and there's still a lot of uncertainty as to how many rate rises we'll get, the quantum of those. So I think there is still a bit of uncertainty and pain ahead for the next probably couple of months until things get clearer. But for the moment, I do think that we are going to get a bit of a bounce in the market. Unfortunately, there is still a real risk that we still see lower levels a little bit later on.
It seems to me that the data flow is going to be critically important, reporting season is going to be critically important, and I've been arguing that probably by the December quarter, provided inflation is falling and provided that it looks like interest rate rises are getting near an end for a while, that will probably be a better quarter for stocks.
Yeah, I think there'll be better times ahead of us. I just can't predict, when that will be.
Gable, have some
Look,
guts.
I can see the trends, and I'm trying to manage the risk with what I could see, and I think the risk is that the market will struggle to do a lot when we have rate rises ahead of us.
Yeah.
So whether they stop in 2 months from now or 6 months from now, I can't predict the future. But at the moment, that's the risk. But that's the big, I guess, telling sign for when the market's ready to rally for investors, and that's when central banks come out and say, look, we're ready to stop here because of this reason and that reason, and then the market can recover.
So for the market to eventually take off, I go back to my favourite Pantene commercial starring Rachel Hunter when she said, it won't happen overnight, but it will happen.
It'll eventually happen.
It will happen. Okay, mate, let's have a look at the S&P 500. Both you and I will agree what's going on in the US is a big driver of what happens here. So what's this market showing us?
Yeah, so I'll just talk through this chart. So, so over the last few months, we've spoken about a few key levels in the market. So initially, when we met back in May, we're looking at this main support level here. Obviously, breaking was a negative. And then when I was here a few weeks ago, around this point, we're talking about how the market rallied back up to that old level and failed to get above it, which has put the emphasis back on the downside. So again, we're still getting these lower peaks and these lower lows. But most recently, what we've seen in the short term is a higher low. So we have this low from June, a bounce, and then a pullback to give us a higher low. And after a few days, the market started to move higher.
Love higher lows, and
exactly.
The more the better.
The more the better, and you need that for the market to get going.
Yeah.
So what I've likened this as similar to what we saw potentially in March, where we had a strong bounce, a pullback for a bit of a higher low, and that gave the market an opportunity to give us a tradable bounce.
Yep.
So if you're a trader out there, you may well get a bounce here that you could trade. Unfortunately, there's not enough here to tell me that this downtrend is over, and for the reasons we spoke about with interest rate rises, we might get a bounce. And look, maybe at best we even get a pullback and a further high low. That would be great.
Let me put it under pressure.
Yeah.
On Wednesday we get US inflation numbers. If they come out a lot lower than expected, do you think that level could be tested?
We may well get a bounce, but then the market will of course turn to what does this then mean for interest rates?
Could be recession as well.
Yeah, so that's the problem. So initially the market was worried about inflation, and then it was worried about recession, and it depends on the mood of the market.
Okay, right, good. Let's go to the next one now, mate, and we're looking at the NASDAQ, and this is the one that really has had a big reaction anytime the bond yields come off. So what are we seeing in the NASDAQ?
So it's pretty similar to the S&P 500 in that we've generally got this downtrend. We've got the higher low. And similarly to the S&P 500, it's back to that little peak at the end of June. So I wouldn't be surprised if tonight's session is a bit muted while it just works through any selling up here. But to me, it does look like it wants to head back to this level between about 12,000, 12,500, and that was the peak in June. So again, a little bit of upside. Obviously, if it clears that high, you're then looking at this high as the next level. So unfortunately, you've got all these levels of trapped buyers that will offer resistance. So it'll be hard going, But again,
By
at least for
trap
the short
buyers, they're
term,
people who have bought, have lost, and if they see that old entry price broken,
Yep.
they'll probably get out, at least with a percentage of their
exactly.
claim,
And
yeah.
I mean, I've been speaking to many investors over many years, and when they're holding a losing stock, they all say the same thing to me, and that's as soon as I get my money back, I'm out of there. So that's why resistance exists.
Yeah, good point. Let's go to the ASX 200 now, mate.
Yes, obviously a bit of a different looking chart in that we had this more sideways movement before the breakdown here in June. But again, we've got this higher low forming. At the moment, we seem to be oscillating between this band here. So it looks like we're readying for a bit of a move. Again, maybe not too dissimilar to what we saw in March where we get a bit of a bounce. But, beyond that, we just have to, it remains to be seen. But I still think for the short term, there's upside potential. But obviously that June low, I'm not very certain whether that's a proper low yet or not.
Yep.
We may well see these levels in several weeks' time.
Yeah, and probably to remind people that massive drop sort of coincided with both the Fed doing a 0.75% rate hike and our RBA doing a 0.5% rate hike.
Yeah.
It really gave the market a real
Bit of
a fear, a spook, or whatever you want to call it. Yeah. Okay, let's go to the next one now, mate. And I've asked you to look at a couple of interesting stocks. And now, Megaport, is one that we've watched over the years and was really in favour when tech stocks were doing really well. Had a big rise about a week or two ago. What are you seeing on the chart itself?
So what I've done here is this is a weekly chart, so each of these bars represents 1 week. As we could see, this chart goes all the way back to 2017.
Yep.
But I've changed the scale, so I've made it a log scale. It just helps understand the movements a bit better. What I mean by that is, as we could see here, $2 to $4, so a doubling of the share price, another doubling of the share price, another doubling of the share price. So even though it's dropped a lot, and that may well seem like an opportunity right now, I think it does need a bit more time because on the log scale, if we compare the recent decline to the COVID decline, as we could see, even though it got smashed during COVID, it's a smaller amount than what it's done now in percentage terms, not necessarily dollar terms, but in percentage terms. So, look, the risk is still to the downside for the moment. We can see a very strong bounce here on the chart, but I think what it needs to do is basically just
Explain
build a bit of a
to
base.
the people watching, Mike, why you say that was a big bounce. What figure in those candles and whatever that show you there was a big bounce?
So this is a weekly chart. So as we could see, each of these candles is 1 week. So if we count back to this candle here, that's 4 candles ago, so about a month ago. And we could see that at its lowest point, it was at approximately $5, and now it's up at $6.35.
Yeah.
So,
And that's a big candle
in
there.
percentage terms, that's a large move. But to put in perspective, it's got, it's copped a bit of a hiding over the last several months. So I think given the scale of this move, what you'll need to see is probably like the broader market. It needs to move this way a bit more on the chart and just give us a bit more of a base until it's ready to get going.
And just for educational purposes, Mike, explain to the viewers why some candles are clear and others are red.
It basically indicates where the stock is closing and where it's opening and where it's closing. So red means that it closed lower than where it opened.
Yeah.
So given this is a weekly chart, if we look at this red candle, it means that it started the week at this level. It closed the week down here.
Yeah. So
a white candle's the opposite. So where you have this big white candle, it's telling you that it opened the week at this level, and then it closed the week up here. So that gives me a quick glance, I can tell the strength of the stock or not. So whether there's a lot of red candles, a lot of white candles.
Like here, there's a lot of clear candles and a big
really
rising
well.
trend.
Yeah.
Ever since the falls, a lot more red. Okay.
That's right. So if we see it move this way a bit more, a lot more white candles at a first glance, that's telling you that it seems to be closing higher than where it's opening.
So we've made a commitment to technical education for investors. Well done, mate. Let's go to another interesting one. Magellan Financial Group. Now, Paul Rickard and I discussed Magellan last week, and I said, it just seems to be a lot of interest around the low $12 mark. And I think I went through it last week. But it just seems to me around the $12 mark, there are a lot of potential buyers. What are you saying? What are you seeing on the charts?
So we've gone back to a daily chart here. I think ultimately, as we spoke about it a few months or so ago, I think they're going to need a lot more time to get the runs on the board again and the performance for the flows, the funds to start.
Yeah, and they lost 5.6 billion or 6 billion last week from advisors. So it's a tricky time for them at the moment. Yes,
it is. So look, the chart seems to be slowing down here, but I've noticed that it's still giving us these lower highs, and what that means is where we spoke earlier about a stock will go, if it can go back up to an old price that where you have all the trap buyers, and that's where they want to sell to break even. Because it's got the lower highs, what that means is it doesn't quite make it up to that level, and because people are that desperate to sell, they just say, look, it's close enough and that's good enough, I'm getting out now. So it does indicate a lot of bearish sentiment is still in the stock. So whether that's justified or not, I think this will continue.
And so it seems to me, Mike, this company needs to report to the market that the actual funds, rather than funds are going in and out, the performance of the fund is back to where it used to be, very good quality returns, and or that when you think about it, the likelihood that it's going to keep on doing that, and the company's profits, reporting season, or saying that the market's really marked them down too hard. But at this point in time, it's not really looking like it's going to turn around anytime soon.
That's right. I think if you could see the fund performance kick up and not just do it for 1 month, if they could start to outperform consistently, then maybe as an investor, you could say to yourself, well, that means that funds will start flowing in, so let me start buying the stock now before that happens, but it's too early.
And I think they have a pretty heavy exposure to US NASDAQ type stocks and S&P 500 stocks. Until that turns around, they're probably going to struggle with that.
And I mean, you then have to also question the the fund manager, in that ask any person on the street, they know that what's happening in the NASDAQ and interest rates and how that affects these stocks. So, how come they haven't prepared themselves a little bit better for that? Yeah,
good point. Let's go to the next one now. This is one that you've liked in the past, being a racy gambling type of person, being working in the markets. Aristocrat Leisure, is it looking good at the moment?
It is. So basically, what we've got here is, I mean, if we ignore this last part of the chart, it's just like the S&P 500. It's got a downtrend. Yeah. But the good thing about Aristocrat is it's started to break that downtrend. So it's put in a higher low. As we could see, the low point for it was in May, near $31, and now it's up near $35. So it's starting to outperform the broader market. It's put in a higher low. It's just put in a higher high, but now it's on the way back down again in the short term. So it's starting to give us that base. So a few more movements like this sideways. Yeah. And then we could say, well, the downtrend's broken, it's got a bit of a base, and it's ready to get back into an uptrend. So definitely one to keep an eye on.
Yeah, and I've noticed a lot of the analysts are very positive towards Aristocrat Leisure right now. Here's an interesting one, Fortescue. We know the miners have copped a bit of a backlash lately, and it always seems to fall by the most and rise by the most. Yeah. What's the overall chart saying about the company right now?
The good thing about Fortescue, if you compare its share price to where it was at the start of the year, it's actually fallen less than the market. So again, I like looking for the businesses that have held up better than the market, because when the market recovers, I think they're the ones that will do the best. Fortescue, what's very interesting about this chart is, again, apart from this little low here a few days ago, the prior low was all the way back in March. So again, broader markets down here somewhere. Yep. Fortescue's held up. So I know this is very volatile and looks very messy, but the overall picture looks very positive for Fortescue. I think in the short term you're going to get a pretty decent bounce in this, and the reason why I say that is, as it's fallen back, I keep an eye on the old low and see what it does at that low. If it can't hold on to that low, that's most often a negative. That's where everyone's got their stop losses. If it can't hold on to that previous level of good buying support, and as we could see here in March, as soon as it got to this level, it launched really, really strongly. Last week it actually broke that low, so ordinarily you'd think, well, that's it, it's game over for Fortescue. But the next day it jumped up, got back above this line, and as we could see in the last couple of days, it's held above that line.
Yeah.
So that's what's known in charting terminology as a false break. So you think it's broken down, but again, immense buying has come in to get it back above that level. So that tells me that should follow through, and at least in the short term, I think you'll get a bit of upside here.
Yeah. A false break. We learn something every day. Let's go to the one that you've offered, and you don't usually bring one that you want us to sell. You usually bring us one that's worth buying. So tell us about Min.
Well, this is one that is worth buying. So again, it's got one of those charting patterns where if you looked at it a week ago,
This is mineral resources.
Yeah, mineral resources, lithium and iron ore. Yeah. So if you looked at this chart a week ago, you'd think, well, it's game over. It's game over. It's broken.
Another false break.
It's another false break, Peter. That's right. You're learning. So,
boy.
Look, I know I've been in and out of a lot of these resource stocks, and I think resource stocks, you do have to trade them. And the unfortunate thing about lithium at the moment is there's this big story around electric cars, and we only have to look at the German automakers now backtracking from the 2035 deadline to stop selling internal combustion engines. They're already backtracking from that. So, look, I think the whole lithium story, it is a story. Look, there's still something there, but people get a bit too excited about what it all means, and it goes up too much, and then it needs to come back down. Yeah, so very wild looking chart, as we could see, moving between about $40 and $60-something over the last year, but a great trading stock. So again, like the broader market, February, March, a higher low, strong rally, has come back. Again, during this recent pullback, I was looking at these lows. It broke that, closed near the low. Well, that looks terrible. But a day later, it jumped back up here, jumped back up again on Friday. At the moment, I think it's down slightly today, but again, it's holding into these levels, false break. There's no certainties, but in terms of probabilities, this is a really good high probability trade. I think you'll get some sort of uplift here. I mean, I don't know where it might stop, but if you're happy to do a trade for a few weeks, I think this one's looking
What's really interesting, Mark, and I always like to try and get some real world added to the technical world that you present when you come. The number of people who've complained about the price of petrol, who are now dying for the day when electric cars are A, cheaper, and B, can be charged pretty easily. That's going to lead to a massive demand for electric cars, and that's when the lithium story will be justified, I think. And I think there's probably, because of the price of petrol around the world, gasoline, as they say in America, all the car manufacturers are going to be really pushing a lot harder to make that day happen when they're cheaper and they're easier to charge up.
But I guess the problem is you might want to swap to an electric car, but if lithium prices are where they are, then you can't move from a $50,000 car to a $100,000 equivalent. It's not going to happen, and unfortunately, I think the link between high energy prices making renewables more attractive, it's not quite that simple, because to build these renewables, to build the wind turbines and so on, requires a lot of energy, and now energy is expensive. It requires a lot of money, now money's expensive. So I think that switch to renewables, as we've seen play out in Europe, it's a lot harder than you think. So what that's doing is pushing back the timeframes. A couple of years ago, we had this great hope or optimism that we'd all be in electric cars by a certain date, and there's there'll be all these developments with renewable energy. But unfortunately, that's getting pushed out, and Germany's turning back on the coal power stations, and the electric car makers are, the German car makers, as I said, are are pushing back on when they're going to stop.
Well, the
producing
one
a
good
ton
thing
from
about that is that my diesel car will have more trading value over the next couple of years, but I thought I'd get very little for it. So Mike, overall, do you think that if we get a period where it looks like inflation is dissipating and interest rates are on the way down, a lot of these stocks will start heading to the upside?
Yeah, look, there's a lot of doom and gloom out there, and I mean, in our business, we read the financial press, and it can get a bit depressing. But you have to realise that, human nature, we tend to, get caught up in the fear and the negativity, but we do come out the other side. And I'm still bearish in the short term, apart from maybe the little bounce that we might get here in the market. I still think the next few months will be pretty difficult, but I know that there's something beyond that, and I'm quite optimistic that the markets can do well, and basically we've got this great opportunity in the next few months to pick up stocks at good levels when the time is right.
Yeah, we've got to remember that media reports news, and news can be negative at the time, but it doesn't mean that it's going to be negative forever.
Yeah, exactly.
Great stuff, thanks. That's Mike Gable from Fenmont Equities. Well, joining me now is Paul Rickard of the Switzer report, and he's looked at the healthcare sector, which he thinks has a real lot of potential. Paul?
Yeah, I think the healthcare sector is going to do pretty well, Peter. In fact, it's been doing well in the last sort of 4 to 6 weeks. Let me show you a bit of a graph that I put together to look at both what's happening in the Australian market and the US market. Now, typically healthcare, at least in the States, is sort of as a defensive sector. And it's probably no surprise that it's done pretty well in the US because the market's volatile, the market's also down, and people flock to safety in the health in a sector like healthcare. So just look, quite the top part of the graph shows you the return of the healthcare, the first 6 trading days of the year. Then we look at June, and then we can see a year-to-date basis. You can see in the US, 2% positive return so far this month. Only lost 2.7% in June compared to the US S&P 500 losing 8%, and only down 6.6 compared to 17.5% for the whole market. So certainly done as you'd expect in the US as a defensive sector. Australia's a little bit different though, Peter. We clearly take our lead from the US as is always the case, but our sector tends to be more growth orientated, and that's because our companies are more niche companies competing in global markets. They're based outside Australia, or the bulk of their sales occur outside the Australian market.
And they're not like big drug companies that even pay dividends.
They're not like big drug companies, and they're very, very concentrated. So they're in 1 or 2 very niche markets, big markets, and they tend to be global leaders. So and growth has been their mantra. So we have stocks trading in pretty big multiples, 30s and 40s in terms of current year earnings. So that's why the Australian sector didn't do as well when the market sold off. But you look at the same period, it's year to date, it's only just below the current market, down 7.1%. But look at the start to the financial year, up 5.4% in the first 6 trading days, and the better performance in June. So the healthcare sector went down a lot in January, February, March, and has come back quite strongly in June and also in July. And I think that's going to continue because there are a couple of forces at work. One is that, from an institutional point of view, the 2 big sectors, banks, question marks about whether high interest rates will really impact, profits and bad debts in the long term. And in the resources sector, people are still worried a little bit about commodity prices and the R word, recession, and what that might do. So there's sort of slight negatives about both those sectors. Healthcare is the third sector, so where does your money go? It tends to go in healthcare. A couple of other things that are helping the Australian companies, so the Australian dollar's lower in US dollar terms. And although they report in constant currency terms, it still does help in terms of their US earnings, and it certainly makes their share prices cheaper back in US dollars, right? Because they're trading in Australian dollars, they're cheaper in US dollars, and that helps offshore buying. And then thirdly, we're coming into reporting season, and our healthcare companies have traditionally done really well in the reporting season, and companies like CSL, Peter, have got a great record of positive surprises, and I think that's all leading to part of the momentum. So in an environment where your other 2 sectors aren't doing as well, your 2 major sectors are looking a bit I won't say shaky, but not as well. These companies are doing all right. They're not going down in price, which means there's almost got to mean they've got to go up. I think there's you're going to see some good performance out of healthcare.
And because you say they're more growth rather than defensive, if this stock market starts to rebound, maybe in the December quarter because interest rate rises are over and inflation's falling, as tech stocks go up, these growth stocks will probably go with them as well.
Yeah, they will, and so that's one of the other positives. Now, healthcare is also, you could argue, is particularly with some of the products is largely sort of immune to the recession. Some just spending goes down, but a lot of it doesn't. Now, so that argues against the growth story a little bit. Maybe that's why they're also in vogue at the moment. But you're right, they're certainly growing, and I think they're going to continue with. So let's look at a couple of companies. The one I think it looks best at the moment, and this won't come as any surprise to our viewers, Peter.
No, we've been big fans.
CSL. And I think what this chart tells you is it just can't go down, right? In fact, if you look at that, it actually bottomed in this cycle in about February, right? And that's despite the negativity we've had in the last quarter. Healthcare's been, and CSL's been going up. Quite a strong rally into the early part of July, which tells me that's institutional money starting to move into it.
Yep.
I think there's more in store, and we can see that well back over $300. Now, the analyst consensus target price well north of $320. Every analyst is bullish on it. The CSL doesn't say much between reporting seasons or reporting times. Hasn't said anything to the market for 2 months, but is saying that plasma collections seem to be on the up. They've got some new technology that are reducing the cost of plasma collections. That should be a positive in the short term. And also we've got the takeover of the new company, which still hasn't been completed because of some regulatory issues, but that will go through, and that's its new sort of growth areas we sort of look.
Have an impact on the outlook statement, I would have thought.
And it won't have any impact on this year's financial results, but. Look, I still think they're confident of getting it done fairly quickly. So
and this sell-off pool looks very much like a tech stock, doesn't it? It's so steep, but unlike a tech stock, it's really
except we're in the multiples of over here.
The
scale is between $260 and $340, but it does look steeper than it is. But I think there's value there. There seems to be also value in ResMed, which is creeping up, and also Cochlear. So I think there's value in each of those. Health companies still trading on high multiples, Peter, and that multiple really hasn't improved too much. But to me, the stocks aren't going down in price, and I think that means they're going to go up. Yeah,
3 good quality companies that if you haven't got in your portfolio are worth thinking about. Thanks, Paul.
Thanks, Peter.
That's Paul Rickard of the Switzer Report. And that's the show. Thanks for joining us. I'll see you on Thursday when all those numbers I talked about, US inflation and our unemployment figure, will be out. If you want to know more about our company, and you want to get more insights into stocks to invest in, have a look at switzerreport.com.au. Thanks for joining us. See you on Thursday.